United States. I guess ICOs maybe aren't dead. I'm also going to throw out here that if you add me on LinkedIn or send me an email or message, I'm happy to send you this entire deck. Okay, so you're welcome to take photos of it. I don't mind, but you can get the entire deck in PDF form, 5 minutes after the presentation, if you just add me on LinkedIn and send me a message. Okay, so there's this company called Blockstack, and in the US, they filed for permission to conduct an A+ offering in the US. And that filing, that request with the SEC has been pending for a few months. It should come out any time. They've done a very good job and answered all the SEC's questions. And they have the Wilson and Sonsini law firm representing them. And if you download all their work back and forth and all the comments, you can see that they've really thought through the issues with an A+. So I think we're about to get the first regulated A+ offering in the US. Once this gets approved, if it gets approved, I think it will be, the floodgate is going to open up, and everyone in this room should be prepared for the opportunity to conduct an A+ in the US, and I'll go through what this all means. So about me in this talk, I'm a US attorney, actually I shouldn't say that, that means I work for the government. I'm a US-based attorney in California. Like I mentioned, I'm happy to share this presentation, and just again, this Blockstack filing has not yet been approved, so this is all a little bit speculative, but it's literally one of those any day things. Okay, mandatory disclaimers, I'm not your lawyer unless you pay me. I'm giving you US perspective. Don't break the law. I call it the Noriega warning. Okay. Now, who's on Instagram or has kids who are on Instagram? Good, thank God. Not you, sir? You? You're not on Instagram, really? You look like someone who would be on Instagram. Huh? Why is that? Because you're hip and happening. You're what's new. No, I don't know. So there's a couple of terms that are on Instagram and elsewhere. There's FUD, which is fear, uncertainty, and doubt. It's what Microsoft tried to do to Linux a few years ago. And there's FOMO, which is the fear of missing out, which is everyone else has a Lamborghini and you don't. Okay? I think there's a lot of FUD about the US securities laws and the SEC, but everyone's also fighting with FOMO because that's where a lot of the customers and where a lot of the investment capital is located. So I'm going to help you overcome the FUD so you don't get FOMO, using Regulation D and Regulation A+. And as someone who strongly advocates for the crypto and blockchain markets, I want this revolution to succeed, and you need, in my opinion, US capital and customers in order to do that. Okay, so I took securities law in law school and then, of course, practice it now. I'm going to squeeze down a semester of law school securities into about 5 minutes and charge you 0% of what I paid for a USC law degree. Who's happy about that? We'll see whether you're happy after I teach you securities law. Okay, so here's US securities law boiled down to just nothing. The key idea number one, the SEC does not have the regulatory power to define what a security is in the United States. Okay? The term security is a defined term. The core law in the United States that forms the basis of all securities regulation is the 1933 Securities Act, and of nearly equal importance, or maybe even of equal importance, is the 1934 Securities Exchange Act. Both of those laws define the term security and grant jurisdiction to the SEC to enforce law based on that definition. Okay, so the SEC does not have the unlimited mandate to define anything as a security. Sir, what's your name? It's also turned around. Rutger. I'm not pronouncing your last name, that's crazy. Rutger, are you a security? Don't think like a lawyer, use logic, not law. No, you're not. If the SEC says you're a security, are you then a security? You sound like an SEC attorney. Okay, no, Rutger cannot magically turn into a security if the SEC says he is. Okay, security is a defined term and you don't fall into any of the defined categories. All right, so if you look, I'm not gonna bore you with, I have separate YouTube videos with long explanations of all this stuff. Security is a whole bunch of normal categories, stocks, notes, yada, yada, yada. And then there's sort of a catch-all category called investment contract. But whatever that set is, that set of things, if something lies outside that set, it's not a security. If it lies within that set, it is a security, for those of you who are into that kind of thing. Okay, now, that's big principle number one. Next idea is that the default rule, and this is what freaks everyone out, the default rule in the US, the default rule, is that any sale or offer of sale of a security, which is a defined term, in the US must be registered with the SEC before it can move forward. So any sale or offer of sale, an offer is very, very broadly defined. Hey, you want my security?
Just a yes.
Okay, that was kind of an offer as far as the SEC is concerned. No, we didn't talk about any other terms, so what the heck? Okay, Rucker, you're like in the spit zone seat. You can get like a million questions. Okay. So the default rule in the U.S. is that any public sale or offer of sale of securities must be registered with SEC, and if you don't register it with SEC before proceeding, it is unlawful. Unlawful is SEC speak for potentially criminal, but definitely a boo-boo. Okay, so that boo-boo can either result in a lawsuit, regulatory action, or referral to a law enforcement agency. Oh, here's another one. Who thinks that the SEC can put you in jail? Yes, no? Okay. The SEC is a civil regulatory agency. Okay? It is not a law enforcement agency. The SEC has no ability to stick someone in jail, bring criminal charges, any of that. In egregious cases like fraud, okay, they may refer a case to the U.S. Department of Justice, and then the FBI may investigate and take action, and criminal charges may be brought. Yes, sir?
Question. It only applies to fraud when it occurs with U.S. citizens, doesn't it? And it has to be in one part of the U.S. citizen. Because
That's where it gets really interesting. So I'm going to basically hold questions for them, but that's a good question. So in general, the disposition of U.S. securities law is that they're there to protect U.S. investors and U.S. market. So there needs to be some level of nexus with the U.S. before the U.S. cares. Because the general perspective is that other countries have their own regulatory agencies, and that we're not going to overreach and go protect those crazy French people. Okay? But if they want to get you, okay, and you're U.S. somehow based in the U.S. or you're using a means of communication that's in the U.S., if they want to get you, okay, they can say that, look, nice try, but you're using the instrumentality of commerce within the United States to cheat these people outside the U.S., and that's a violation. It's a point of context. There's actually a couple cases on this that have just recently come out, but I think one case is if a country requires that certain transactions take place through a broker or dealer, and then you from the U.S. don't use a broker or dealer in that country, the SEC has the option of going after you. That's like an example. So it's a gray zone. But for the most part, the SEC only cares about protecting U.S. markets and U.S. investors. But you can't wormhole your way through committing fraud and rely on that. Well, I only cheated people who are not U.S. citizens. That's going to look real good. Okay, so general rule is public offerings must be registered with the SEC by the issuer. The issuer, this is a key term, because this also relates definitely to blockchain and crypto. If I'm an entity and I'm selling my own securities to the public or to private parties in what's called an initial distribution, my first sale, so that those sale proceeds come back to me, the issuer, and I use them in my cap table, I'm issuing securities. Okay, I'm differentiating that from secondary market trading, which is everything that happens after that initial sale. So public offerings must be registered if the issuer is selling securities. All right? And otherwise, it's unlawful. Okay, now registering is tough. Okay, it's expensive, it's slow, it's gotten more tough over time, and for that reason, most of the time, by the time you get around to a registered offering, it's usually a large-scale initial public offering or IPO. Now, the IPO market in the U.S. has dried up for a whole bunch of reasons, but it's worth keeping in mind that when companies used to be founded, or when companies were founded, the founders and initial investors used to be looking to an IPO in order to get their liquidity at some point. So someone would invest in a startup company, like a VC would invest in a startup company, with the hopes that 6, 7, 8 years down the road there would be an IPO and they'd have liquidity at that point. But if the IPO market has dried up in the US, how do you get your liquidity? Fine, you go around the rules and you do blockchain. There you go. We'll talk about that. So IPOs, initial public offerings, registering, offer real benefits, but they're usually vast overkill for a startup. Okay, you just finished the first third of a securities class in the US. Right. Now, here's a big pitfall that a whole bunch of blockchain and crypto companies are walking right into and they don't even know it. The general idea is that after you do a registered offering, after you do an IPO, you're the vast majority of the time can be considered what's known as a reporting company, meaning that you don't just need to register your initial sale and go through all that fun times with the SEC. You now are under obligation to conduct yourself as a reporting company, as a publicly traded company. That means filing quarterly reports, annual reports, complying with Sarbanes-Oxley, all this other fun stuff that is very complicated. And you also have a whole other layer of fiduciary duties to your shareholders that you don't have if you can avoid registration. So generally, again, unless you're a large company, being a reporting company under the SEC rules is a real hassle. I'm going too fast, too slow, right speed? Audience feedback? Okay.
Too slow.
Too slow?
No.
Jan.
No, just
This
kidding.
is my buddy here. Okay. You want to get in front of the camera so you can see your face since I'm pointing you out? No, don't be shy. Okay, so here's the trap for blockchain companies and for crypto companies. Suppose you entirely avoid the United States. You go, I'm not going to sell to a single U.S. investor because they're freaky, and I don't want to deal with the SEC. Well, you don't just become a public reporting company by virtue of conducting an IPO. If a sufficient number of U.S. investors in aftermarket trading get their hands on your securities, you're now basically participating in the U.S. market, and even though you did do an IPO in the U.S., you now need to nonetheless register with the U.S., with the SEC, as a publicly traded company in the U.S. I'll say that again. Even if you completely do not sell to any U.S. citizens or don't use a U.S. nexus in your sale of securities, if in aftermarket trading, a certain number of U.S. investors get their hands on your securities, you now qualify, whether you knew it or not, as a publicly traded company in the U.S. because the U.S. investment market is now being affected by your actions. Who do those Americans think they are? Well, I don't know, but that's the law. Okay, the basic rule, and everyone always asks this, is if you get over 500 unaccredited investors, and we'll talk about that, you're now publicly traded in the U.S. If you go over 2,000 accredited investors, you're publicly traded in the U.S. It is real easy to go over both those numbers if you're selling crypto and not regular securities. Okay, you're gonna have crypto holders in the tens of thousands, hundreds, or millions, easily. Right? So all these companies that did ICOs outside the US, that's a problem. And like I mentioned, this happens as a result of secondary market trading. Okay, so you guys you're 2/3 done with your US securities law class. Congratulations. Okay. Now, everything I just said applies to regular securities, but it applies equally to security tokens. Now, I think there was some debate back and forth about, every token's a security token. Are you a security token? No. Turn your thing around so I just don't bother Rucker. Anthony, okay. Are you a security token? You're not. Okay. If you pay dividends, are you? No, you might be, actually, if you pay dividends. Okay. But if you take a non-security asset and tokenize it, it doesn't magically turn into a security. And I'm going to break conference protocol and mention something that came up in a conference, in one of the panels. Just because a token is tradable or exchangeable, that doesn't magically turn it into a security either. Don't believe that. Okay? Timeshares and condominiums are tradable. They're not securities necessarily. Okay? Commodities are tradable. They're not securities. Things sold, my mother's shoes sold on eBay may be exchangeable, but they're not securities. Okay? The fact that something is exchangeable, the fact that there's a liquid market for something does not make a security without adding more facts. Okay? There's plenty of things on this planet that are exchangeable and tradable that aren't securities, even in formal public markets. All right? So someone's going to come up and kill me after the presentation, but that's okay. Okay, so think about a security token this way. It's a token that's purchased with a profit motivation, which provides an economic stake in the fortunes of the issuer, remember what the issuer is, or the underlying platform. Okay? It often has functionality that's similar to a stock, a bond, but the key idea is it's some other passive form of investment. If a token only produces economic value for me based on my own efforts, that's not a security, that's not passive. Okay, if a token lets me work for money, for example, that is probably not a security. Okay, if it's my efforts that are producing the economic result. A utility token could be, by way of contrast, it's something that has independent use value. So anyone familiar with Microsoft Office 365 or Google Apps, if you put those platforms on the blockchain, and instead of selling software licenses, merely tokenized access, which they might very well do, okay, those are not security tokens. Okay, I'll just say that again. If you have Google Apps and you tokenize access to it, you didn't magically turn Google Apps into a securities platform. Okay, that's a really easy way to think about a utility token. The platform's worked, you can have access to it. Okay, you guys all got an A in US securities law. Congratulations. We'll have a graduation beer afterwards. Okay, so what are the top 3 techniques for avoiding the SEC and avoiding registration? Well, the first technique, and we'll kind of dive into these because they all relate to A+. The first technique is you just don't sell security tokens. If it's not a security, the SEC has no jurisdiction. Okay, contrary to what the SEC thinks, it doesn't rule the universe. The SEC can't declare war, can't raise taxes, can't regulate commodities, can't regulate access to forests. It only regulates securities. Right? And the usual argument that people make that, oh my God, if you don't regulate it as a security, it's not to be regulated. I don't know what drugs they're on, but at least in the US and I'm sure in the EU, everything is regulated. Okay, the fact that something is not regulated as a security does not mean it's not regulated. Okay, everything is regulated. Commodities, breathing, going to the bathroom, everything's regulated. So the fact something's not regulated as a security doesn't mean it's not regulated. Okay, so don't fall for that argument. Okay, so technique number 1 is, well, you just don't sell security tokens. You sell utility tokens, for example. The other favorite technique is you prevent US investors from participating in your initial private sale, ICO, IEO, STO, whatever you want to call it. Right? For the reason we discussed, the fact that you can go public later in secondary market trading, that's not a good idea anyways. It's not a fail-safe, but we'll dive into this a little bit. The more solid technique for avoiding registration is to engage in what's known as an exempt offering. Exempt. So the default rule is that you need to register your sales or offer sales of securities in the US, and registration is bad. Hopefully there's an exception. Hopefully there are exceptions, plural, and there are. There's many carve-outs from that rule. You do not need to fall into that default rule. It is rare to fall into that default rule. The right thing to do is to find an exempt offering exemption, what's called a safe harbor. And some of the favorite ones are Regulation D and Regulation S. So who's heard of, just so I can engage my audience, who's heard of Regulation D and or S? Come on, you've heard of D. Private placements? Okay. You, sir, I know you have. Yes? Yeah, okay. So those are your top 3 techniques. Now, Regulation A+, I'd say either improves on these or works in tandem with these. And it just became much more useful as of a couple years ago. Okay, so let's dive utility tokens a little bit. The law has gotten clearer and more befuddled in the US extremely recently. The SEC used to pretend that every single offering of tokens in the US was a securities offering that should have been registered. Okay, Chairman Jay Clayton said something to that effect when he was being grilled by the Senate. You know, he hasn't seen a single offering of tokens that isn't an IPO. And I just wanted to go up to the TV and throw my Diet Coke at it because he's not a lot. He's misrepresenting, let's say. Okay, but the SEC, having gotten slapped around by all these US parties that are being like, why are you sending all our business to Malta? Pushed on the SEC, and now the SEC has come out with 2 things, a no action letter and also some guidance. In that no action letter, they said that in a particular case, an issuance of tokens does not qualify as an offering of securities and you don't need to register it. So they just admitted in public, on the record, that it's possible to not have a security token in the US. That is a big walk back from where they were before. And they also admitted that if you're selling a token in the US that's not a security, you do not need to register with the US, with the SEC. But just exciting enough, 2 days ago, Kik got sued by the SEC. Kik is the company that conducted an ICO in 2017. They claimed that their token was functional and not a security. The SEC basically invited them to provide a letter explaining why that's